we're deep into a pandemic. It seems to be this is a once in a lifetime public health emergency. And in the investing world, it's what we call a black swan event, something that you thought was impossible until you see one. What started out like a little cold for our economy progressed to the flu and now sounds like a dose of economic pneumonia. I've never seen so much panic spread so quickly. And I'm not talking about the battles in the supermarket queues. I'm talking about the fear that's spreading, concerns about our personal health, about our jobs, about our economy, about our property markets, and I guess the value of your and my home. Now, clearly the Morrison government's promised a further stimulus package to keep the Australian economy moving. The RBA is stepping in again. But this pandemic is an unprecedented threat to the Australian economy, with the stock market falling around 30% over the last 3 weeks. 60% of Australian businesses now reporting they're going to be affected by COVID-19 to some extent or another. Now, while other commentators have given their views on the stock market or on the health, I'd like to concentrate today on what it means for the property markets. Is there anything we can learn from the past to predict what's likely to be ahead? So they're the questions I'm going to ask Australia's leading housing economist, Dr. Andrew Wilson, Chief Economist of myhousingmarket.com.au. Hello, Andrew.
Hello, Michael. I'm glad to see you still smiling. I'm smiling too.
Yes, we are, because we've been there, we've been around before, but there's no doubt the virus is going to cause illness to some people, and tragically it's going to kill a number of them. And even though we're talking about property today, I don't want people to think that we don't care about other people, about their health, about those in need. We're also concerned for those whose jobs are at risk and who may suffer from the isolation, whether it's mental health issues or just restricted social exposure. But we're not qualified to discuss those matters. So rather than that today, I'd like to hear your thoughts about the economy and our property markets. So, Andrew, how worried should we be?
Well, look, obviously we've got two different elements here, Michael, to worry about. We have a health issue and then we have an economic issue. Now, these things are obviously interrelated because the consequences of actions to offset the health issue are that we're going to see reduced demand and a period, hopefully not too lengthy, of reduced economic activity. This is reasonably predictable as we are now being exposed to a period of uncertainty due to, health concern. Then obviously we are concerned and obviously our governments are concerned as well. But I'm not sure that we're not moving into the same sort of panic mode in terms of our government responses that predictably consumers are moving into at the moment.
Well, Andrew, clearly the real damage currently is being driven by consumer and business sentiment and market psychology. And when they hear that the share market is dropping 30% and your superannuation funds are now not going to be worth much. But I get your point that is the government doing the right thing? Yesterday, I suddenly heard that Victoria is in a state of emergency. Yes. And to be honest, for a sec, my heart stopped and I thought, what sort of emergency?
Well, it's an extraordinary response to what are still, and as you suggested, we're not downplaying this health issue in any sense. The numbers of infections are still low in relative sense. They're obviously likely to grow. I think politicians are under a lot more political pressure now to act sooner rather than later. And I think we've seen that maybe to the detriment of the medium-term outcome economically in the US and perhaps in Australia. Now, we know the US are in the midst of a very bitter election cycle at the moment. Obviously, the imperative for the US government is to act sooner rather than later. Similarly, we have political pressure on the Australian government. The Prime Minister was roundly criticised for being absent during the bushfire crisis in Australia early in the year. He was on holiday, and perhaps he doesn't want to be seen to not be acting sooner rather than later in this particular health emergency. The question is whether we're throwing too much of our ammunition early days into a problem that, except for sentiment, of course, really doesn't exist yet. And the problem there is that it'll actually create more issues economically through a sense of, let's not do anything, let's not buy, let's not sell, let's not conduct our jobs until we get some more clear air. Now, this issue will be resolved when the health issue is resolved. That's when this illness moves through the community and starts to settle, and we can feel a bit more relaxed about the outcome, and then we'll be less inclined to panic. Now, that's when we're going to need economic stimulus to pick up the pieces. To my mind, we've thrown a lot of that ammunition early days at an economy which it's not going to make the slightest bit of difference until this health issue is resolved. People are not going to start spending, are not going to be active in the economy until their fears regarding the health issue, until they're eased. And that's obviously going to be at least a month or so, all things being equal, and as a positive, optimistic outlook.
A lot of people are wondering really what $750 in the hands of pensioners or others who are in need going to do. Are they going to actually grease the wheels of industry? And as you clearly mentioned, once the number of new cases starts to go down, it's a sign that we're over the hump, that they're trying to minimise with the social distancing. And we've got some ideas from what's happened overseas as to how long that could take. So if the industry isn't going to keep operating normally for a while, is Australia going to go into recession?
Well, recession's a bogey word, Michael. It's really meaningless unless you look at the context of the particular economic environment where this recession occurs. Now, as we've said a number of times in this series, a recession technically is where we get back-to-back periods where GDP falls into negative territory. Now, the last time that happened was in 91, 92, but the circumstances of our economy was completely different then as to what it is now. Now, obviously, given issues with tourism, students, and even our export trade, we are going to take an economic hit over this quarter and the next quarter, which may result in those two negative measures of GDP. But GDP is already low, Michael. The December quarter GDP number was just 0.5% growth over the quarter, which is low, and it has been low for a while. But we still have quite a reasonable labour market and quite a reasonable position in terms of our general economic environment, despite that low GDP number, which of course reflects low incomes growth and of course low inflation. What I'm trying to say is that the consequences of moving from a low number positively into a low number negatively, I don't believe will be significant to the point as we experienced back in 90, 91 and 92, when we saw unemployment rates skyrocketing over 10%. I think obviously there's likely to be higher levels of unemployment, but certainly, in my opinion, not at the extreme levels that we had in the recession of the early 90s, and certainly not anywhere near the issues that we had during the Great Depression, which was our other significant economic event. So, yes, we're likely to get that technical measure, Michael, but I'm not sure that we're going to see the same sort of severe economic impacts, particularly on unemployment, that we've seen in our last episode, which of course was 30 years ago.
Well, it's hard to compare this with other classical recessions, whether they're overseas or in Australia, because in general, those recessions have come after periods of excess, of excessive over-demand, of speculation, of loose money, and then the government brings them on to slow things down by raising interest rates, which unfortunately, as you say, creates unemployment. So it looks like they're going to be quite different. I think the other big difference between this and the 2008-2009 global financial crisis is that there's no systemic risk to the money markets. The government has learned some lessons, it's intervening early, and the banking system is much more sound. It's much better capitalised than it was back during the global financial crisis.
Yeah, a few interesting points, Michael. Firstly, we don't rely on cash as much as we used to. So cash isn't a physical commodity as it once was, where you have periods of economic instability and financial instability. People are motivated to withdraw large amounts of cash. I mean, we now transact in a digital environment. So that's a safety net, if you think about it, in terms of our capacity to continue to transact. And if we look at those economic circumstances being different, if we look back to, and we'll talk about the share market now, the previous significant share market event that we had, which was in 1987, came in an environment where we had inflation running at 9%. That's 9% versus what we have 1.6% now. and interest rates then were at around 16%, and they're zero now. So you can see it's a completely different environment. But in the market crash of 87, we saw the All Ords down by 48%, which has been the most significant fall that we've seen in our share market since the Great Depression. Now, by comparison, we've had a decline of 28% so far in our All Ords through this event. So we're still not in that territory that we were in 87. But 87 was a response, as you said, to over demand. Interest rates were high because inflation was high. We have the reverse now occurring. So this is basically just a panic response to what governments have told us. It's not that, it's a health issue, which will pass through the system, hopefully sooner rather than later. And when it does, we obviously will have to recover because this will have an impact economically. And that's when we need to be obviously thinking about how we can assist that recovery. But we're not in that position yet, Michael. So all these actions now are really not going to have any impact until we start to feel better about the health environment that we're in at the moment.
I agree with that. So it's probably really a bit more like 9/11, where there was a major disruption to the world economies for a short period of time, but then moved on, compared to, I guess, the global financial crisis, where some countries still haven't gotten out of their economic shock. No doubt that property markets are going to be impacted. And so it's going to depend a bit upon how sellers feel, how confident they feel putting properties on the market, how confident buyers are going to be. Of course, we've spoken before about we should be fearful when others are greedy and greedy when others are fearful. Not taking advantage of people's situation, but taking advantage of an opportunity of what's going on. So it'll be interesting to see over the next couple of weeks auction clearance rates, how many people are listing their properties, because people are still getting married, they're still getting divorced, they're still having babies. Life's going on, and there are more of us coming to Australia.
Yes, Michael, and it's very similar to what our property markets were experiencing a year ago. A year ago, property markets were spooked. There was a lot of hysteria in the media about the potential for what turned out to be quite ridiculous predictions of house price falls last year. Consumers fell into that particular prediction, and of course they were hesitant to particularly sell a house, and we saw listing numbers crumble quite sharply last year. Markets recovered as the market righted themselves as the fundamentals started to become more pronounced, and of course low interest rates helped as well. But this is a similar environment, Michael, where discretionary sellers will start to think, well, let's wait and see how this particular event pans out before we sell. So it is similar to last year, which was a short-term event, really only lasted a couple of months, and typically sentiment issues that don't have a fundamental economic drive to them. And the predictions, as I said last year, were nonsense, and they were not based on any hard economic analysis. But nonetheless, it had an impact. So we're likely to see that impact this year similarly, Michael, and similarly it will be the length of how the fear factor evolved. Hopefully that will be a shorter journey. But so far, Michael, my housing market tracks national listings on a daily basis. And I started to see a marginal fall in listing numbers through the end of last week and the beginning of this week. But that's actually now stabilised. Listing numbers actually increased over the week ending yesterday versus the previous week. But we shouldn't be surprised if there's some tapering off of activity from sellers. But of course, that'll depend on sentiment going forward.
Well, we've got to remember that just going back to the global financial crisis, to the times of the recession in the early 90s, after the stock market crash in 87, and I remember that very well, our property markets boomed. The share market volatility reminded many investors that the best way to grow their wealth is in the safety of bricks and mortar. But it's actually different this time round. We've got the lowest interest rates we've had, meaning the cost of debt, if you're a home buyer, is going to be low. If you're an investor, the cost of owning a property, even if it's a little bit negative again, it's the lowest it's going to be for a long, long time. So I think, Andrew, if you've got a secure job, a pre-approval and a financial buffer to see you through, it's going to be a perfect storm of events where if you can take a long-term view rather than the short-term view, there should be some good buying opportunities for real estate in the next month or two.
Well, that's right, Michael. And talking about economic stimulus packages, I think that government should think of targeting particularly demand-sensitive sectors such as property to get the economy back up and running again. Now, we can learn lessons from history. In 1983, the Hawke government, the new Hawke government, we come out of a recession in 82, stimulated the economy by introducing the first home buyer grant. And that had a remarkable impact on the economy. It got the construction industry up and running because it tapped into what is that very significant unmet demand from first home buyers in Australia. I think that even though, and we've seen that this year with that initiative for the first home buyer deposit scheme, bringing first home buyers into the market, I think that can be broadened or a different type of policy can be introduced to tap into even more first home buyers to get them into the market. And I also think that the government can look at actions to release a lot of the tapped demand from developers and investors who are still finding it tough to get finance for their projects. So I think that there are mechanisms to reinvigorate the building industry, which is always a key driver of economic activity, particularly jobs, when we move into the recovery phase of this particular issue, which hopefully will be sooner rather than later. You know, rather than throwing money at people as is occurring now, which, as you suggested before, is likely in the short term not to really have any impact.
I guess at times like this, we can easily get into a frenzy, get into a panic. So it's important to have this bigger picture perspective, not make 30-year investment decisions or home buying decisions on the last 30 minutes of news. I also think, Andrew, 2020 is a year we're not going to forget. It's going to be firmly embedded in our minds. This is in some ways a once in a lifetime experience. But I think when you look back at 2020 in 5 years' time, in 10 years' time, it's likely the events aren't going to have a large or lasting impact on the global economy or on the future prosperity of you and me, our families, or the value of our homes or investment properties.
Well, nothing's changed, Michael, other than the fact that our mindset is obviously lacks confidence now, and the fear factor is there. And of course, that's quite normal and quite natural, and we shouldn't dismiss it as being irrational. But this is a test for governments, Michael. They're our leaders. They now have to show real leadership and grit rather than reflect what consumers are doing at the moment and obviously reacting in a sense of fear.
We've been around long enough to remember the times where they did feel scary, they did feel difficult. So it's much easier for us to actually stand here, sit here at a distance, giving some thoughts and advice, which we're going to keep doing once a week in these regular Property Insider videos. Thanks for your time, Andrew.
Yeah, thank you very much, Michael.